Hi, I'm Ryan Lightfoot-Brown of Chelsea Financial Services. We're joined today by Nick Kirrage, co-head of the Global Value team at Schroders. Thank you for joining us.
Nice to be here.
So Nick, you're famously value investors, but with markets being so high at the moment, are you seeing any value left?
We do continue to see value opportunities, but what we find is that they tend to be concentrated in quite specific parts of the market. Typically, larger companies are cheaper than smaller companies, but also we're seeing value concentrated in certain sectors, those that have cyclicality or particular concerns in the news, like banking or financials more generally, and or commodity-related stocks where people are very unsure of the world.
So we're seeing an increasing likelihood of interest rates going up. Do you think this will cause a value rally? This will be the catalyst for it?
It's certainly one catalyst that people are talking about for a potential value rally, and there are technical reasons for that. But more simply, if you looked at the kind of businesses that find themselves in the cheap value parts of the market, things like banking, interest rate rises would be positive for those sorts of stocks. Having said that, it's certainly not the only catalyst that we could see, and there are other ways that we could envisage value having a better time period going forward. One of the things that's interesting about value is typically it was a very defensive form of investment going into recessions prior to 2009. In 2009, it wasn't defensive, and that spooked people. But looking forward from today, a number of the value sectors, to our mind, have much more rigid or robust financials, better balance sheets, and cheap valuations. And that typically can be very supportive if markets find themselves in difficult times. So we could see two or three other ways in which, that being one, in which value might outperform.
The retail sector has been quite heavily hit of late, especially in the UK. Are you starting to see some opportunities now, or do you think it's more of a value trap market?
We've been looking very closely at retail over the last 6 months because you're right, it is flagging up as looking attractive on valuations. Our concern would be that in many cases we might be too early. Valuations have come down, but profits have yet to fall. Also, retailers have very particular risks associated with them, with their leases and with all their stores. So trying to work out those kinds of risks and how they relate to the returns we might make for clients. Last summer we looked closely at 30 global retailers and we only ended up buying 2, which tells you something about how picky you need to be within that kind of market.
Absolutely. Well, thank you very much for coming in, Nick, and thank you very much for watching. Goodbye.